So on this problem, the cash flow problem, we're going to do it the indirect method. So the first thing we start with is the net income. And that is listed down there at the bottom at 62,500. The next thing that we do in the indirect method is we add back the depreciation. But here we don't just have a depreciation value. We see down here that we purchased or we sold equipment costing 25,000 for 7,500. So what we need to do is kind of find a spot and do our depreciation T account. And on that, we notice that our depreciation started at year one. This is the accumulated depreciation, started at 715,000. And we know that we ended up at 762,500. Okay, but we also know we sold that machine, which cost 25,000, but had a book value of 62,500. So we need to take that difference. And so if we take 25,000 and we the book value is 6250, that means that we had 18,750 in accumulated depreciation that we wrote off. And so now we need to know what this entry right here is. That will be my depreciation. It will be my accumulated depreciation, but entry, which is also the offset by the depreciation expense. So we take the 715,000 and we subtract the 18,750. So that means that after we wrote off that asset, got rid of the accumulated depreciation on it, we had 696,250, and then we subtract the 762,500, and that means our entry had to be 66,250 in order to get to the 762,000. So we add back our depreciation expense, and that was 66,250. All right. So then we can go in any number of order here. I'm going to go through the accounts receivable. We were up to 100,000 from 85,313. So that means we had an increase of 14,687. So an increase in accounts receivable is a decrease in operating cash flow. The next one we have is the inventory. We went from 181,250 to 206,250. And so we went up by 25,000. And again, an increase in a current asset is a decrease in operating cash flows. Would be the change in inventory. Prepaid insurance, we went down 2,500. to 1875. So we have 625, 625. So that's the change in prepaid insurance. The long-term investments, land, building, equipment, and accumulated depreciation we've already taken care of. So now we move down to the accounts payable. We were at 185,838. And now we are at 95,425. So that is a decrease of 90,413. And so with current liabilities, those move the same direction. Salaries payable was 30 and now is 30,625 and now is 25,000. So that's 5,625. And again, it went down. So the operating cash flow went down. Notes payable, long-term bonds, common stocks. So none of those are operating. So we're done with the balance sheet accounts. Now we need to look down and see if there's anything in the narrative down there at the bottom that we haven't picked up yet. So we sold available for sale securities costing 86,875 for 92,500. So that's a gain that will go into the investing. So we have to take it out of the net income number. And so we will subtract the gain. And that was 5,625, the same as the salaries payable. On that, let's see. We issued bonds at face value. We don't need that. That goes into the financing. Purchased new equipment. That goes into investing. And we paid cash dividends. That goes into financing. And so that's it. All we have to do now is sum that all up. So we have 62,500, 66,250 plus 14,687 minus 25,000 minus 625 plus 93 5625 minus, and I get a negative 11,975 from that. And that looks about right. Let's see, 90, 115, 125, 126, 28. Yeah. That's about, oh, what about that one? Yeah. So that's about the right number. All right. So that should be the answer.